Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share evidence-based holistic insights to help you master the game of building wealth. And so let's get into today's Q&A episode. Got lots of great questions, and let's start with a question from Salman. I am just going to summarize his question. He has asked if there is any value in creating a superannuation account for his children, which are currently aged 10, 7, and 4, and then contributing a certain amount into their account, invest it in high growth. It's going to be more tax effective in the long run. And he thinks if any of his children don't do that well financially, at least it'll give them a bit of a head start and potentially, secure their financial position in terms of enjoying a comfortable retirement. I mean, it's a really good question, Salman, and it's a good idea. Like, the idea has merit, I should say. The first thing you're going to have challenges with is that, a lot of the larger superannuation funds only allow accounts in minors' names if the minor is able to work, so of working age. I think that's around 15 years of age. Could be wrong, and it could be different in different states as well. So, to open a super account for a 4-year-old, I don't think there's going to be many super funds that are going to allow you to do that. And so one way to navigate that or get around that is to have your own self-managed super fund, because you could certainly include them as a member of that super fund. But I don't recommend that either, and I'll come back to that in a second. I guess the question is, where should we save for our children's future? And the answer generally is to look after yourself first as parents. So if you prioritize making your financial position as strong as possible, and then hopefully get yourself into a position where you have surplus assets, so that is more money than you need to fund your own retirement, well, then you'll be in a position where you can help children whenever you feel like they're going to need help, rather than necessarily make that decision today. Because, and this is not really, it sort of bleeds over to parental advice from financial advice, but sometimes not helping people is more helpful than actually helping them, because it gives them a sense of their own achievement and allows them to take responsibility for their outcomes as well. So you wouldn't necessarily, in a financial planning sense, want to lock yourself into achieving a certain outcome and then also relinquishing sort of control over that wealth as well. I mean, if they're not doing well financially, potentially they might get access to those monies under the hardship provisions. It is a little bit difficult to do, but not impossible. And so if you take the viewpoint that you say, well, I'm going to do everything I possibly can to make my financial position as strong as possible. That way, I'm going to have 3 children. If I've got 3 children like Solomon does, chances are, one will need more help than the other at different times. And you can't anticipate or predict those things, especially when they're as young as Salman's kids are. And so, as I said, if you put yourself into a position where you can, if the time eventuates, you can help them in different ways to different extents potentially, then that's going to probably help you navigate those things. The other thing too is, if we really think carefully about it, if we have a child that's not going to be doing well financially, so that means either, they've got limited earning capacity, their income is pretty low, or if they've got a high income but they're terrible with money, they're probably, off the top of my head, the two sort of potential outcomes. Well, having a home in both those scenarios, potentially having a home is probably the most important thing, and the thing that's going to give them a sense of financial security. And, if they buy well in terms of take an investment lens or approach to that decision, that could end up being their best investment as well. So I would argue, as parents, particularly if you've got very young children, locking money inside super, theoretically, yeah, that could really help them. But practically, I think you're actually better off to keep that money outside super, so that, for example, when they're in their 20s or 30s, or when they're ready to do so, if you wanted to help them get into the property market, you could do that. Obviously, you can't necessarily do that with superannuation. I just want to touch on one point that I made, not really relevant to Selman's situation, but worth mentioning nonetheless. That is mixing parents and children in a self-managed super fund. So we've seen situations where that has occurred. What has happened is those adult children were then subject to a relationship breakdown that went through the family court. The family court froze the self-managed super fund, so the trustees of that fund couldn't make any changes to investments. And then, of course, that impacted the parent situation, and they were in retirement at the time. So not only do we have probably different risk profiles, different investment time horizons when you are mixing or comparing parents and children, but also there's that family law matter as well. I just don't think it's really worth parents and children being in the same self-managed super fund. So not always a fan of that, but or at least you want to think about the pros and cons of that. That great idea, Selman. I think theoretically a great idea. I'd probably just take a different approach as I've explained. Okay, next question is from Steve, and Steve's asking about franking credits. He says that he knows a friend that has a self-managed super fund and that gets in excess of $35,000 in franking credits per year. And because they're in pension phase, they get a full refund. And he's asking me what happens to franking credits in the industry fund. He's saying, I assume the franking credits are spread amongst all the members in that fund, both in accumulation and pension phase. Is that correct? He's saying that he's in a defined benefit fund, so he can't do anything at the moment. But when he goes into retirement, maybe that's an advantage of having a wrap product or a self-managed super fund, because you get to quarantine the franking credits that are directly related to you. So, Steve, you're right. In a what's called a pooled product, which is often also called a unitized product, a pooled product has to be unitized. And that's really a way to describe an industry super fund or a very large super fund, Vanguard, whatever you might want to, those sorts of products. Means that everything is kind of in one pot. And then each member has a certain number of units in terms of share of that pot. And that's how their balance is determined. And so, of course, a super fund might have a certain amount invested in the ASX market, the Australian share market. It's obviously going to enjoy franking credits. Some of those assets will be used by people in pension. Some of them will be used by people in accumulation. And so it all washes out in the long run. I guess where there's going to be an advantage is where you had a particular investment strategy that would give rise to a lot of franking credits. And so previously in this podcast, I've talked about, in a case study episode, talked about a equity income strategy, which is, and I would caution people from necessarily adopting this strategy, but a lot of investors do, where they invest in equities mostly for the income and a little bit for the capital growth. And so that there's a few high yielding ETFs that do that. Vanguard's got a high yield Australian ETF. And the filters used to build that index is really, who are paying the highest dividend yields in the share market. Now, if you had that strategy, it would be good to quarantine those franking credits to make sure that you got the best use of those assets. Now, we've spoken about in this podcast a few times the advantages of having a wrap or a self-managed super fund over a pooled super product. Capital gains tax is one of them. Quarantine franking credits will be one as well. But you do get the indirect benefit from an industry fund. To what extent does that benefit get watered down just because you're pre-mixed with a whole bunch of other members is really going to depend on your balance and how your money would have otherwise been invested in a different non-unitized structure. So I'm not sure that I would go and change it just because of the franking credits. I think it's one of these things that you need to think about when choosing a super fund. You obviously want to choose a solution that's going to, be easy to manage, that you're comfortable with, that minimizes fees, that maximizes returns, and that maximizes tax outcomes. And you want to sort of balance out all of those priorities, not just necessarily focus on one tax outcome. So the short answer is, yeah, you'll get some indirect benefits of those franking credits. And should you switch just because of that? No, you wouldn't be just because of that. You would want to switch to a different style super product because there's lots of other benefits that you may or may not like, right? So that would be the reason to do it, not just really tax. Okay, next question is from Sam from Perth. Sam's 31. He's got 2 kids and a wife with a combined family income of $270,000. We're moving into our family home and we have about $300,000 of cash from the sale of investment property. Sold it because it was an investment grade, located on a busy main road with power lines in that proximity. And he's wondering what the best use of the funds were. The house needs renovation, and to make it for their forever home, that would cost around $250,000. Alternatively, what he could do is just do some minor renovations and then gradually renovate over time, given that he feels like he might be overcapitalizing as comparable homes are about 1.3 and his current value is just a little over $1 million. So you're getting close to sort of the top end of that range, if you like. Or should he do the full renovation and then just use the equity and go and buy an investment property? And he's concerned that the Perth property market might level out and it might not be a good investment per se, that is to do the full renovation. So to put some numbers around it, the current value of the home's a little over $1 million. He's got a current home loan of $680,000, as I said, about $300,000 of cash and renovations of $250,000. It's hard, Sam, to tell you exactly what I would do in that situation just based on the preliminary information that you've given me, which is not to suggest you should have given me more information, but it is difficult to say, all right, this is what you should do. Having said that, my gut feeling is do the renovations. So spend the full $250,000 on the renovations. Now, if you spend the full $250,000, it means that you've got about, the current value plus what you spend on renovations means that the property needs to be worth 1.3. And you're saying that you feel that's towards the top end of the range in the suburb. I'm not really worried about a client overcapitalizing their home in the long run. I am if it's a significant amount of overcapitalization, but, we're not, I don't want to be flagrant here. But, if you're in the property for 1.3, if you do the renovations, and let's say its market value today is 1.2, it's not really going to change outcomes very much. And you then get the home that you really want without making any compromises. And so I guess this is a bit of sort of balancing out financial planning and then lifestyle considerations. But you may as well, it's funny, I was chatting with someone on the weekend about this, that people tend to, complete their home to the standard they want just before they sell it. That there's, I was talking to someone that did a major renovation. He's still got a bunch of things that need to be done. And we just laughed at that comment. Well, we'll probably get to it when we want to go and sell that asset. And of course, that's just human nature. But it doesn't make sense, right? You may as well enjoy the full renovated property because ultimately that really does add, for most people, a lot of utility to their standard of living. And the reason that I like that idea is that it will then position your property to really enjoy as much growth as possible. So, you want to have an asset that is in keeping with expectations of an area. And even if you're going a little bit beyond the expectations of an area, as long as it's not too far beyond, it's going to be a very desirable property, which means that if the value of homes in that location are going to appreciate, that your home's going to pick up that full appreciation. So I think, in the very short time, you could be overcapitalizing, but I think in the long run, you'll be completely fine and you won't be overcapitalizing. Plus also, I have a different viewpoint in terms of how much steam is left in the Perth property market. And so I think in a very rising market, I think in 12 months' time, you'll look back and go, well, that was a really good decision. Then by funding those renovations through cash, you will then have more equity in your home, and then you could borrow against that equity. I might have already mentioned it, but Sam has employee shares that he gets as part of his remuneration, which obviously attract tax as well. And so having some additional gearing in his name will help him at least save some tax, particularly given he'll be in a high tax bracket. So improving the value of the property, reducing the loan to value ratio, freeing up more borrowable equity against that property, and then allowing him to then gear and then go and buy an investment grade property will be beneficial in his situation just because of his tax position. And I don't really worry so much about, the long-term outcome in terms of capitalization. And it will give him the improved livability of the asset as well without feeling like he kind of made some compromises. Sometimes doing piecemeal renovation ends up producing an inferior product at a higher cost. And so, if you have a renovated kitchen but an unrenovated bathroom, most people you go and sell that asset, most people are going to look at that and go, that's just weird. We want either full renovation or no renovation. You're kind of in no man's land. So that's a long-winded way, Sam, of saying I would, from what you've told me, and it's, as I said, caveat is it's very hard to give you definitive advice, and this is not advice in this podcast, I would do the renovation. Okay, next question is from John, not his real name, but the name he would like me to use. He said he's listened to pretty much every episode I've produced and recommended the podcast. So thanks so much, John, and I'm glad you've really enjoyed the episodes. John is essentially asking me what would I do if I was in his shoes. He's married, both his and his partner. So actually, I'll just give you the rundown of his current situation. Then I can have a think about, what would I do if I was in his situation. So John and his partner, both 46 years old. He earns 230. His wife earns $30,000. They've got 4 kids, aged between 15 and 21. So 3 more years of private school fees for the youngest child. Their home in a capital city worth $1.5 million, no debt, no plans to sell it for 20 plus years. They spend about $120,000 a year excluding investment property expenses. They'd like to spend $150,000 a year because they'd like to do some travel. In terms of their investment assets, they've got 1.44 million in a family trust, mainly in ETFs, exchange traded funds, so that's in the share market. The net equity after capital gains tax in their investment properties, so he says he's got several investment properties, about 1.5 million, 1.45 million. So that's sort of after repaying the loans, all that sort of stuff. That's just pure equity. And then in terms of super, $1.2 million combined. They've been using catch-up contributions and maximising concessional contributions, and will continue to do that. And their aim is to have 4 million by age 60. So that'll give them close to, and about 2 million each. That'll give them sort of trying to maximise the amount that they have in super that's going to be tax-free. And so John said, well, what would you do if you're in our position? And he's given me kind of 3 options, which is pull the pin and retire. John reckons, based on his modelling, even if you retire today, you still have about 6.5 million of investment assets by age 60. So what are you waiting for? Option 2 is reduce working to 2 to 3 days per week for another year or 2 to get acclimatised to reducing work further and sort of fattening up buffers. Or number 3, keep slogging away at it for another couple of years, get your investment assets to $5 million with a even better buffer. So John, it's an interesting question. What would you do? I mean, it really does depend on your goals and risk profile and all those sorts of things. I guess you're 46, you've still got at least the youngest child in private schooling for another 3 years. What are you going to do over that time? If you've got a kid in schooling, it's not like you can probably do the amount of travel that you'd like to do, given the age of your child. No judgment there. You might like to go on a really long holiday, but just practically, from my perspective. The other thing I would encourage, if you're my client, I'd ask you, what are you going to do when you're retired? Where are you going to get that sense of, contributing to something beyond yourself? And one of the other things work provides is it keeps testing us, and we're always learning new skills, meeting new people. There's a bit of socialization in there. So, if you retire at 46, that's great. But what are you going to do to sort of fulfill those needs? Because that's really where most people kind of fall down a little bit in retirement. Those things disappear when they stop working, and, they don't have as much fulfillment as they otherwise would have. So, and I'm saying this mostly because you've got a child in private school, so you've got a lot of, some unusual expenses or not reoccurring long-term expenses at the moment that you won't have in 3 years' time. So if I was in your shoes, I'd probably reduce work 2 to 3 days a week. It kind of give you the best of both worlds. You're not going to be working full time. You've still got some work that's going to still add some fulfillment, hopefully, and also defray some of the living costs. So you don't need to then draw on your capital or income as much as you otherwise would if you weren't working. Get through the period, when your kids are no longer in school, and then arguably you've got a little bit more flexibility if they're going to uni or they get their own jobs, or that they'll become a little bit more independent, therefore freeing your wife and yourself up to probably do more of that travel. And then you'll be able to see what sort of suits you. It might be even, I've got some clients that do sort of contracting work, and that's been a sort of transition into retirement sort of strategy for them where, they might pick up a contract, some consulting or whatever, work for 3 months, and then take the next 3 months off and go on holiday and so forth. I feel like that gives them a sort of good balance. And I'm thinking about sort of longevity risk as well. Drawing $150,000 a year off on living expenses. If we've got a starting balance of 4 million, you've probably got enough. But I like to be a bit conservative. I'd be a little bit more comfortable if you had a little bit more, something closer to that $5 million. I mean, you might end up, who knows what life expectancy looks like in 20 years from now, for instance. So you might actually have to, fund another 50 or even 60 years of living you don't want to be in a situation where you're going to potentially risk running out of money. So I'd go for the part-time work, but thanks for writing in, John, and thanks for your lovely feedback as well. Okay, next question is from David. David said he was just listening to the episode about investing in property inside super. And he's asking if a self-managed super fund is predominantly invested in residential property, earning, say, a 3% net income yield. Let's assume the loan is repaid. How do you value the super fund? He says, I'm thinking in terms of the minimum 4% drawdown. So, of course, that means that if you're in pension phase and you're aged between 60 and 65, each member of that fund, if they're both in pension or they're all in pension phase, has to draw 4% of their member balance at the beginning of the year. And so that means that if you go and revalue your investment property or the self-managed super fund's investment property, of course, and the value comes in much higher, then you've got to draw a lot more in terms of pension payments. You can do a recontribution strategy, of course. So if you had 3% of income coming through, that's not enough, of course, to pay 4% pensions. But you could pay sort of 2%, and then if you're able to, recontribute that bit back in as a non-concessional or even concessional contribution and draw another 2% out. So it doesn't have to be one lump sum of 4%. In fact, it can be monthly amounts if you like. So there's a way to kind of get around it, particularly if you don't need the money, and sort of navigate that. Also, a 3% net income yield, that's relatively high. I mean, it's not impossible. But, once you factor in all expenses and so forth, it tends to be less than that. Now, let's get back to David's question, which is really how do you go about valuing a property in a self-managed super fund? Well, you've got to the trustees have to come up with the market value of those assets. And then those market values will be audited by the self-managed super fund's auditor. And it's going to depend how stringent that auditor is going to be. And so the trustees need to have evidence. What evidence did they rely upon in order to strike that valuation? And it could have been a bank valuation, for example, particularly if you got a copy of that from the bank. That could be used, to determine the value. A letter from a real estate agent citing 2 or 3 comparable sales of what they think the property is worth. Or in fact, your own research, which could include looking at sales of comparable properties in close proximity in the last 6 months to your asset in order to strike its value. It's going to come down to the auditor, though, and what they will accept. If you've got an auditor that's pretty lax, you might be able to get away with undervaluing, in inverted commas, the property and therefore minimising the amount that you have to take as pension. But I should say that most self-managed super fund auditors less flexible these days. There's been a lot more focus from the ATO on making sure these audits are done properly and they're asking all the right questions. But that's how you'd go about it. Of course, you want to comply with all the rules if you're going to embark on something like this. So it's really about coming up with a value that you think is realistic for the property, noting that valuations should probably be expressed in a range rather than an actual dollar value figure. Because, of course, it's very difficult to value property. It really does depend on the market sentiment, the conditions. Every property is different. And so I guess the aim is to try and be towards the lower end of that range rather than the higher end of that range. And that's typically doable in most situations. But, I'd be using a combination of those sources, looking at, what's online, comparable sales, a letter from a real estate agent. That will typically be enough data and information to support a trustee's valuation on that asset. But as I said, if it's just really getting around the minimum pension payments and the property is producing, let's say, $20,000 of income per year and you have to pay $40,000 out in pension, well, you might just make 4 $10,000 payments for your pension and you might recontribute those $10,000 payments as a non-concessional contribution if you're allowed to, if you're within your caps and so forth, and you're then just recycling the money and then at least meeting the minimum pension payment requirements. That can be one way to sort of navigate around that, David. But if you've got a self-managed super fund, speak to your administrator or accountant in regard to that. They can walk you through it. Okay, next question is from RC. RC has been a long-time listener. Really appreciate the information and content provided each week. Thanks very much. I have a question relating to a fairly recent podcast, episode 326, which was the second part of investing in super that I did last year. And this was part 2 with the title Pros and Cons of Using a wrap to Invest in Super. In part 1, I talked about the different options: retail, industry super fund, self-managed super fund, etc. And part 2 was really just dedicated to wrap accounts, mostly based on feedback from through these questions, wanting to know a little bit more about wrap accounts. Anyway, RC goes on, my question relates to unrealized capital gains. And given I'm in my mid-30s, I would be adopting a very long-term investment strategy, investing in, say, a premixed option like VDHG, which is a Vanguard High Growth Diversified ETF. And he's got a couple of questions around, well, what could upset, if you tried to then mid-30s, trying to invest your super in a way that's going to avoid paying any capital gains tax on unrealized capital gains, which is one of the benefits that a wrap platform offers that I sort of spoke about in that podcast. Okay, so you mentioned swapping platforms or providers would trigger capital gains tax. So I'm wondering what would happen if the platform, so Netwealth, Hub24, Macquarie, whatever, it ceased operating. Would this also trigger capital gains tax? Well, it would be if they wound up the product. But if you think about Netwealth and Hub24, that is their core business. They're both listed entities, and that is their core business, is to operate these wrap platforms. And they're highly profitable, highly successful businesses, and they've achieved scale. That's what you really need to do if you're in a wrap platform business. You really need to achieve a certain amount of scale. And there's there's a long time horizon of investment before you get there. But Netwealth and Hub24 have got there. I guess it's possible that if they wound up their business and force everyone to move, yes, it would trigger capital gains tax. I think the more likely option in that scenario would be they would be sold, and normally they would sell the entities, the responsible entity, the trustee, all those sorts of things. So arguably nothing would change, but it is an important point, RC, that you would want to go to a provider, a wrap provider that is going to have that longevity. So if you go to someone that's brand new, that is your risk, is if they don't work out, they're going to have to increase fees, and then you're sort of locked in, or even worse, they go out of business. I think if you're dealing with one of those really large platform providers, Macquarie, Netwealth, Hub24, I think the probability or the likelihood or risk of that is pretty low. He said maybe a different option is to use a member's direct option within the industry super fund. These inside super funds, they allow you to buy direct shares and ETFs. Maybe there's a better chance of that being around in 25 years. Yeah, look, they're probably always going to have that option, I guess, in those industry funds. But as I said, I think if you're using a big provider, I don't think it's a big risk. He goes on, would having a self-managed super fund provide greater protection against avoiding capital gains tax? Absolutely. Because then you are the trustee of the super fund. Well, you're not. You'd have a company, or you might be individual trustees. But the point is that eliminates the counterparty risk. You could use a different platform, and you could switch from Netwealth to Hub24 to Macquarie within a self-managed super fund, because the trustee's not changing. That's not a capital gains tax event. They're just a service provider. So definitely having a self-managed super fund would allow you to get around that. He also mentions what happens if the ETF ceases to be around anymore. They wind up the product. Yeah, that's a problem too. And it can be a problem with ETFs, by the way. We've come across it in a couple of occasions where the ETF provider just decides we're not going to offer this product anymore. And it can be a real pain in the neck, to be honest, because if we've invested under a certain thematic, we think we want this exposure. And if the ETF doesn't attract enough money, or the ETF provider makes a decision, they might say, we're going to wind that product up. And they might do that before that thematic has kind of played out. It can be a challenge. I guess if you're going to invest to try and avoid capital gains tax, and using your scenario, RC, I probably wouldn't use a premixed ETF. I would probably go with the traditional, Vanguard International, Vanguard Australia. You might put in some A200 there, stick to those really core products. And that way you can then build something that's going to be more focused on capital gain. And what I would say there is, arguably, I'm not saying you should do this, but one of the things I'd be thinking about would be, well, the Australian market makes up 2% of developed markets. It's not that big a deal. So why wouldn't you just have a greater skew towards international markets, particularly they deliver less income and more capital growth, more compounding capital gains. And if what we're trying to do is maximize returns and minimize tax, the best way to do that inside super is to earn most of your return in capital growth rather than income, particularly if we feel we're going to avoid having to pay that tax on those unrealized gains, which is kind of what RC is getting at and what I spoke about in episode 326. And so having a greater skew towards international shares, not having too much in fixed interest, for example, in bonds and so forth. You might have a little bit of exposure to the Australian market, maybe a lot less than you otherwise would think. I wouldn't, on a very long-term time horizon, you wouldn't expect that you're going to earn less returns, although you've got to then think about, well, what about the US market? Because it's pretty high at the moment. And I think returns from developed markets are going to, over the next 10 years, are probably going to come out of markets other than the US. The US might have a little bit more to go, but you just want to think about that. I'm sort of prattling on at the moment, but, this is the thing, right? I don't really want, I talk about some things to consider in this podcast. And what I want to really make super clear is that when I talk about these matters, I'm not suggesting that this one matter is the most important thing. So avoiding capital gains tax inside super is the most important thing. As I said just previously a few minutes ago, it's really about getting a balance between fees, returns, taxation outcomes, something that is easy to manage, keep it as simple as possible. They're all the things, and there might be a whole bunch of other things in your circumstances that you need to then overlay as well. But that's really, it's about a balance, and taxation is only one of those elements. And final question from RC, which is still on the same theme, which is this avoiding capital gains tax. What happens if your super is greater than transfer balance cap? Well, then capital gains tax is levied. You'll have to pay some capital gains tax proportionately. So let's say the transfer balance cap is $2 million, which is the amount that you can have inside super and transfer into pension that's going to be completely tax-free in terms of earnings and capital gains tax-free. And the 2 million transfer balance cap will be what it will be in 1 July this year. So it's 1.9 at the moment. Let's say that's what it is, but you've got 3 million of super. Well, in that situation, 1/3 of your capital gains will be taxable. So 1/3 of your unrealized gain, you will pay 10% tax on that third portion. So if you breach the transfer balance cap even by a little bit, you're not talking about much tax at all. And there's nothing you can do about it anyway. The law is the law. Of course, that transfer balance cap is indexed, I think, to wage inflation off the top of my head. So when we do projections, we actually project what the transfer balance cap will be in, say, 15 years, for example. And that helps us work out, how focused it should be on super today, in 5 years' time, in 10 years' time, and again, allows us to develop a long-term plan. So apologise for your long-winded question at the NRC. You don't need to apologise. I should apologise for my long-winded answer. But thanks for the question. You do bring up some really good points. I think particularly the ETF longevity point that you made or question that you had, something that, through experience, we in our business have experienced. And it really does make sense to really think very carefully about, whether the ETF product that you're considering will be around long enough for your investment thesis to play out, because that's really obviously an important decision. Anyway, I'm going to leave it there for now. I'm very conscious. I really don't like going over half an hour too much, and I look forward to speaking tomorrow. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.